This is Colin Cattell with Palisade Radio, and returning on the show with us today is David Skarica with addictedtoprofits.net. David's been on the show a couple times before, and he's a good friend of mine. David, welcome back on the program.
Thanks for having me.
You know, we're recording this on Friday. It's about noon, March 6th. I think we're having another one of these PDAC curses where right after PDAC everything gets slammed. I know that PDAC has nothing to do with that because the entire market's falling apart right now except for the US dollar. Tell me what's going on in the market today.
Well, today what's interesting is you could kind of see this forming for a little bit, that obviously even though I'm long some gold and precious metals, you know, we were kind of grinding lower for the last few months, which is usually a bad sign when the seasonally strong period of January, February, when you don't see follow through on the rally. It's kind of what happened in 2013. That's usually not the best sign for the gold and precious metals. And in terms of the bond, a lot of the global bond market kind of blew off in January. I think at that time, something like a third of global bonds were negative yielding, which is crazy. And then, you know, now it's still, I think, a quarter. A few bonds have come out of negative yield. And you could really see the TLT, which is the ETF that tracks the U.S. long bond. In January, it really hit a huge overbought level, and it has started to roll over too. And if you look at the momentum indicators on the TLT, it had not been this overbought since 2011, and really actually only two times in its history, 2011, 2009, was it this overbought. And actually, in each case, very kind of severe sell-offs kind of followed each case. So I think that, and then now, maybe because of the way bonds are trading, people are getting more in the mindset that you might see a couple interest rate increases by the Federal Reserve sometime in the middle of this year. And I don't think they'll ever go too crazy. Like, they could increase rates 1 or 2 times. It's not a big deal. And of course, that's whacking basically all asset classes except for, as you just said, the U.S. dollar.
Okay, but David, I'm getting a little bit concerned now. We had this negative correlation between gold stocks and the general market, and then today we had very small mirroring of a 2008 style pullback whereby the market pulled back and gold stocks got hit even worse. So if you think, the gold rally's maybe going to get pushed back a little bit now, which I'm guessing that's your thoughts, what do you see happening if the rates get hiked and the Dow drops back a little bit? What's going to happen to gold?
Okay. Here's the thing, is that if you believe, like I do, that we're in a major topping process for the stock market, okay? Like we are where we were in 2007 or 2008, and the market's going to be headed lower. What's interesting in both those instances, okay, gold stocks did rally a bit from mid-2007 to mid-2008, but what was interesting in each instance, like essentially the first phase of the bear market into October 2008, and into November of 2000, the market peaked in March of 2000. Gold did not really rally, and the stocks did not really go counter to the market. But once the Fed kind of switched from, or really started loosening or printing or whatever, then we saw this switch where then actually it's interesting is that the gold and gold stock traded inverse to the market, meaning that while the market went lower from late 2008 into March 2009 and went lower from late 2000 into middle of 2002, the gold stocks had huge rallies. So this is one thing that's always bothered me, even though I'm long gold right now, is that what happens if we get the scenario where gold goes down with everything at first and then switches kind of like midstream and then begins to move higher? So I think that's one thing that is kind of a warning here, that it's more like the 2000 period, because we have a tech bubble like we had in 2000. Gold had been going down for years into 2000, just like it's been going down into years now. We're into 2007, 2008. Gold had been going up with everything. So I think it's more similar to that. So, but the problem you have is maybe it just gets sold off with kind of everything at first before it reverse courses. See, because like the stock market itself is a game of chicken. And what I mean by that is this. It's that, okay, stock market going up has been one of the reasons the economy has been able to recover a little bit or remain strong in certain segments, like the 1% making money and rich people having stock market gains that they can go buy their Mercedes or their, or the Rolls Royces with or whatever, right? So but then if it gets too strong or shows signs of strength, like in today's employment report, then the market sells off. But then perversely, the market sells off too much. guess what? The economy weakens because the wealth effect is gone, and the Fed then has to loosen again. So it's just big. It's the dog chasing its tail. Like I said, it's a game of chicken. It's never going to end well, and it can't end well because of the way that the setup is. It's basically kind of like a Ponzi scheme. It's never going to end well. So the question is, when does that shift happen? When people realize, oh, the market's going down. Oh, because the Fed's going to raise. Then it's, oh no, the market's gone down too much, so the Fed has to print more. So like, when does that kind of shift in people's kind of mindset in terms of the gold stocks? Like that's when the gold stocks will shift. And by the way, that's why I think you still have to be long some of them, because you can look at the 2000 period. The HUI began the year roughly at 65 to 70 that year, and it bottomed at 35. So it actually fell almost 50% at one point. But by 2002, the HUI was over 150. So even if you had bought at the beginning of 2000 thinking, okay, tech's a bubble, I want to buy gold to protect myself, you still ended up doubling your money while the rest of the market went down 40, 50%. So that's the thing. It's just the question is, when does that shift happen? And if you look at the stock market itself, you have this 3-year plus year period now where the market has not had a 10% correction, where it's doubled in that time frame. And whenever those two things have happened, no correction of at least 10%, the market doubles and more in a 3-year period. I looked at the history of it. There's only a couple occasions, and they were 1926 to 1929, 34 to 37, 52 to 56, and 84 to 87, and 62 to 66. So they're like about 5 times it happened. And what's interesting about those 5 times is in each case, there a bear market, started, and in 4 of the 5 cases, the bear markets were really, really severe. The only one was 52 to 56, where the bear market wasn't as severe. But the other ones were basically starts of secular bear markets or actually crashes.
Speaking of the severity of a bear market, the only benefit of what's going on in the gold stocks, I mean, the HUI is down to 167 right now, and it could make a new low very easy after this sell-off today. The longer these bear markets go on, historically from gold, when they turn around, the further they go up and the longer that they usually last. So for an investor who's purely in gold stocks, that might not be a great thing to hear because they're going to suffer along the way. But for your subscribers, gold only makes up maybe 20 to 30% of your portfolio, and this could be a good opportunity. If you want to talk about that real quick.
Yeah, well, let's look at the HUI back, because the only similar bear market we have to this is kind of the 96 to 2000 bear market, and that was about 4 years in length. The HUI went from 213 to 35, so it went down over 80% in price. So if we have a similar kind of percentage decline, the HUI could go to, I don't know, about 120 or there's about this time, which would be still about another 20% from where it is today. Okay, but here's the thing. There were corrections in 2002 and 2004, etc. But essentially, the HUI went up straight for 7 years from 35 to 500. It went up 2,000% before the next really major bear market in 2008. So it went up for 8 years, actually, and it went up 2,000%. So if you're looking at this, again, being another 4-year bear market, and if it's another actually 4.5-year bear market, like that bear market, it would bottom over the second half of this year. You could be talking a major, major bull market in the gold stocks where they're going to go up. Like, again, let's just say it's a similar kind of percentage gain. So the HUI does good to 120, just for argument's sake. Well, a 2,000% increase off that would be a 2,500 on the HUI, So, yeah, that's that positive, is that just like they say, the bigger they are, the harder they fall. Also, kind of the harder they fall, the bigger the bull market is usually after that. So if that happened, I would probably rebalance my portfolio and really go more long the gold stocks if we got a 120, 130 HUI. And the one thing, too, that I've been doing is I still have a strategic short position in the market. I was telling you, I own kind of a VIX ETF, which tracks the VIX to the upside. And I just started buying that, just a trading vehicle. And I have put options on certain companies, and I own some of the inverse ETFs, and I have short positions. So for me, I would have mixed feelings. Obviously, no one wants to lose money on gold going down, because I don't want to lose money in my gold positions. But on the other hand, if I'm right and it's like 2,000 and you see this break in the market, which is then followed by a bottom in gold, I can use profits then on my short positions to rotate into gold. So it doesn't, like, it's not something that I'm really, that upset about, to the downside here in gold and gold stocks. If that happens, if it's preceded by a bear market. And it's hard to know because the market's gone up so straight for so long. Is this finally the top? I think the warning signs are there. One of the key warning signs on a market top was that if you look at this last move, especially in the NASDAQ 5000 thing, it was fewer and fewer stocks. You had a handful of these tech stocks, which is exactly what happened in 2000. When back then it was like Cisco, Sun Microsystems, Microsoft, etc. And this time it was like Apple, the Netflix, etc. Some of the biotechs. Very small amount of stocks kind of driving the indices higher.
And speaking of short positions, David, another short position that both of us have been talking a bit about is this short Japan debt deal that Trey Knipp has put together. So he's a guy that I've had on my show a couple of times, good friend of mine, and you've actually had a couple podcasts with him of late talking about the opportunity. I know some of your subscribers were very interested, but had a little more questions in terms of how the trade worked. And I want to take a second to explain that and then get your thoughts on the 10-year bond yield in Japan and a lot of the other countries around the world. Essentially, Trey is taking in $30,000 for his fund. He can do smaller amounts than that, and he uses $500 a month to buy short-term puts on the 10-year bond yield. And just to give people an idea of the amount of money that can be made, if the 10-year bond yields go from where they are right now, just up a couple hundred basis points, you're talking about over $1 million in profit from $500. So it's a huge trade, and only Trey can put it on. I want to get your insights into it, though.
Yeah, I think this is really important to talk about because, see, when I've done a couple of issues on this, and I've mentioned people to set up an account with Trey, and you have one, and I'm just about to set up an account with him as well to do this trade, and I'm starting a small fund over the next few months, and my fund's going to set up an account with him as well. And I think this is important because, I had a lot of my subscribers write me back about this trade, and I do own a couple of the ETFs that are, say, short the Japanese bond. But I owe them, but they don't have the leverage that this trade has. Like, I really think that an individual consider this trade because you're talking about 30,000, and that 30,000 is over a 5-year period we should stay, right? So that means all you need is that Japanese bond to crack between now and 2020, and I think we're getting close to the end game in Japan. So it's like that's the key part of it is, okay, like if you own one of these funds, ETFs that short the Japanese bond, you might triple or double or quadruple your money. But this kind of thing gives you the leverage of 1,000 to 1 or whatever the case can be. And that may sound outlandish, but you look at, again, like what Kyle Bass did during the 2008 financial crisis when he owned CDS on institutions that went under, et cetera. He had a $30 million fund that turned into $500 million with just a couple percent of the assets in those short vehicles. So this is the same kind of trade where, and Bass talks about being short Japan himself, that if what he says happens in Japan and what we think is going to happen in Japan, just having a couple percent of your portfolio in a trade like this, like Trey has put on, could possibly mean that 1 or 2% of your portfolio could go up thousands of percent, and then your whole portfolio could go up hundreds of percent at a time when most people would be losing money in the market. So the actual Japan bond itself it looks to me like, again, I talked about this global bond market kind of bubble. We're still seeing the European bonds rally because they just started their QE. But if you go look at when Japan upped the QE, say, last year at the end of October, Japan bond rallied for another month or two. So I think the European bonds may rally another month or so, but we're seeing a major blow-off in the global bond market. And you look at the Japan 10-year bond has already doubled in yield from 0.2% at its low to 0.4%. Okay? So I think this is the start of the move lower in the Japanese bond market. And I know the Japanese yields have been so long for so long, people are like, why can this happen now? And here's why I think it can happen now, okay? Number one, we have not seen a significant amount of weakness in the Japanese yen till the last year or two. That even when the Japanese were still running huge debts and huge deficits and had a stagnant economy all the way through the 2000s, the yen essentially being strong. So weakness in the yen could potentially trigger a selling panic in the bond, even in domestic Japanese investors, because they may want to try to get their money out of the country. So that's number one. Number two, Japan was running huge trade and current account surpluses, essentially meaning more money was coming into the country than leaving the country all throughout the 2000s and early 2010s. Because, Japan is a big exporter. We all know that Toyota, Mazda, Sony, etc., all these big companies are based in Japan. Well, now, because they devalued the currency so much, and even with the decline of commodity prices, they still have to import all their commodities. They're starting to import more than they're exporting, and the devaluation is not really having a huge effect on exports. Helped a little bit, but not hugely. We're seeing that the current account is turning from a surplus to a deficit. And if you look at any history of a bond market bubble and crash, and this goes back to, like, say, in countries like Turkey, Argentina, Venezuela, the Weimar Republic, Germany, etc., what you'll see is you need that current account deficit to really start to widen, because then the country has to borrow to subsidize the current account, and then at some point the bond market revolts against that. And that's the key right now. To me, the biggest key event in Japan is their current account deficit is now in deficit and is getting in a larger deficit, and they can't use that current account surplus to subsidize their fiscal deficit anymore. So to me, that's the end game right now in Japan. And they're kind of between this a rock and a hard place. It's like, if they keep printing the equivalent of $3 trillion US a year, they're printing about $1 trillion. But remember, the Japanese economy is only about less than a third the size of the US economy. Okay? So they keep printing the US equivalent of $3 trillion a year. It's too much, and the currency is going to collapse. But if they stop that printing, the market there is now addicted to that printed money. Okay? So what is going to happen is the bond market's probably going to sell off because there's going to be no one there to buy the bond anymore. So they're just totally trapped. And the question is, when does this end? And the great thing about this trade with Trey is it can end 2 or 3 years from now, and you will still make money. So I really think they're nearing the end game in Japan because of this current account deficit, because now we're seeing significant declines in the population there as well, where people, again, would have to be sellers of bonds to raise money to live off of in retirement, just common sense. So I think now we're nearing the end game, and with a trade like this, like I said, I don't know what someone's financial situation would be, but if you can afford essentially a $5,000 to $6,000 trade per year over the next 5 or 6 years, I would highly recommend this, because these kind of black swan events are usually where you can make a great amount of money, and actually sometimes more money than you could ever make being long an asset.
Well, that's right. I want to use this time to summarize now and get your thoughts moving forward throughout the year. For our listeners that don't know, David is located in the Bahamas, and he spends much of his time sitting on a computer in front of the ocean analyzing historical charts. He's authored a couple books, and he's got a great analysis to look back at history and see where we're at today. Gold might not rally as quickly as we had previously thought. What's the thoughts on gold? What's the thoughts on a potential rate hike? And what does that mean moving forward this year? How are you going to set your portfolio up to take advantage and protect?
Well, I already have a pretty well-balanced portfolio, and one of the interviews we did when you were visiting me actually in December, I talked about buying Russia, and I still have these Russian positions long, and they've actually done really, really well. We're talking some of these Russian stocks are up 40, 50% in just a few months. So I still kind of own that as an equity play, because Russian companies are one of the few markets in the world that are very cheap. I have a strategic short position. I'm actually kind of doing something similar to what Trey's doing in the Japanese bond and put options, in that I have a specific amount of money, small amount, $5,000 to $10,000, short these companies via put options. And then when I have small profits, I take them and then roll it into another trade, so I can always have that 5,000 or 10,000 exposure, because when the market tanks and the premiums on puts explode, you can again make like a 20, 30, 40, 50 to 1 trade. And if you don't believe me, there was a guy named Martin Zweig who bought put options on the stock market in 1987 in September. And when the market crashed, he basically bought these S&P puts for an average about roughly $2 a share. He sold them at an average of $40, and the last tranche that he sold were for $125. Okay, so that's kind of what I'm looking for if we get a big correction or crash type scenario. So I have these selective short positions along with some ETFs that would benefit as well. And then I have a handful of maybe individual companies that I think are cheap. And, obviously in a market downturn, they would probably be taken down. But if there's no major market downturn, these are companies I think can kind of outperform. So really it's like a selective market like a Russia, still owning gold shares, obviously having a good 20 to 30% kind of cash position, and selective shorts, and maybe one or two kind of story stocks, which I think are fundamentally undervalued. Like that's essentially what I'm doing. I'm trying to be very, very well balanced. And look at when you're balanced, what you can do then, the advantage you have is, let's say again, you own 20% in gold stocks, and let's say gold stocks fall 25%. Well, then your 20% allocation has gone down to 15%, and then you can top off that 5% again by buying down at lower levels, just like you can sell on the way up. So I think this is kind of like a prudent way of doing this situation.
Right on. Well, David, thanks so much for the interview, and I'm sure the weather is wonderful in the Bahamas right now. All the investors that were at PDAC would be jealous and envious of you to be down there.
Yeah, and just so you know, Colin, because I am from Toronto originally, and I had all my friends writing me like, "Oh, you coming to PDAC this year?" And I was like, "It's March in Toronto. What do you think?"
There you go. Smart decision.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen, or are you too stupid?